Assalamu Alaikum everyone, welcome back to another video. So what happened is recently I went out with a friend who I haven't seen in ages, and we were talking about all sorts of things, and then we start talking about investments. I told him what I've been doing, the fact that I started this channel last December and it's doing okay, and I'll share my ideas and this and that. Then I shared that with him. He actually subscribes, he's probably watching this video right now. And then we said, you know what, he said to me, why don't you do a video where you can just like give us an idea of where to start. So what companies would you buy if you were starting right now? If you're restarting, what companies would you invest and why, and so on. Just give us a little bit, and say for example if I had it £1,000 or £10,000, what companies would you put your money into straight away, and so on. Around the same time, another brother in the community have asked the same question, and he said he's got about £9,000 he would like to invest. He just wants to buy and forget kind of portfolio, which is very tricky because when you stock picking it, you can't really, you can buy and forget about it, but you still have to do a little bit of research. Okay, and I'll talk about that in a second. So that's what we're going to do today. I'm going to show you loads of different companies that you could potentially buy shares in right now, or maybe wait for a dip or whatever. But this is basically just to give an advice to someone who is starting from scratch. And please can you make sure that you know, I'm not a financial advisor, so just do your research, make sure you know the business model, make sure you know everything before, basically everything about that company before you invest into that business. Okay, because remember, in the end of the day, these are business. Adobe is not just a stock, it's a business model. Okay, it's the actual business that exists. So you need to know how they make money, what basically where they spend that money, and how profitable this business is. And if you don't know that, when a crash happens, what are you going to do? Because you don't have any idea of how they make money, and the fact that you can't predict their future and so on, because you don't know anything about the business, you will sell it straight away. And this is what happens when a crash happens. The people that end up selling is people that own stocks that have absolutely no idea of. They don't know anything about Adobe. They bought it because of someone else said it, and all of a sudden it went down 20%. There's no like attachment to that business. There's no understanding. What are you going to do? You're going to sell in the low, and you're going to lose a lot of money, and that's going to kind of stop you from investing in the stock market, right? So hopefully that just clarifies the fact that I'm not a financial advisor. Hopefully you need to do your research before this. But let's get started in the video. In fact, before I start, I want to ask answer a couple of more questions. The first thing is, one of the brothers wanted to know about the account that I'm using here, the what's it called, Trading 212. So Trading 212, I've just read in the last 24 hours, I've been busy kind of reading through their financial report that they've actually submitted to the FCA now. And one of the things they mention is in January of 2020, which is now, they will restart taking new customers. So that is a very, very good news. So they said they will start taking new customers in January 2022. I don't know exactly to whether it's the end of the month or beginning of the month, but yeah, keep an eye on that. If you are still haven't, you know, if you're still waiting, maybe just use the links that on my videos. Okay, so in every video that I shared with you guys, there's a link somewhere around here where you could just click. I think it's somewhere here. Okay, yeah, there we go. So Trading 212. So that takes you straight to Trading 212 account. You get, I think, about free share. I get one as well. Freetrade there's another one there as well. So yeah, just use that if you're interested and you want to know basically and sign up, and just put your name for now, because Trading 212 they've got like a waiting list, so you can put your name on the waiting list, and once that account opens, they will definitely email you, hopefully. Right, the other thing I wanted to talk about is one of the things that I've been sharing with you guys, and that is this spreadsheet. So the spreadsheet, or the tracker that I've used here, I've shared this with you guys a long time ago, and one of the brothers asked me if I can share it. I've shared the whole thing, so you've got loads of different tabs. All you need to do is click this link. For if you are UK based, I think is this one here. Where is it again? Where did I put them? Freetrade. Yeah, there we go. That's the spreadsheet there. So if you are UK based and you click that, that will, if you're US based, is actually easy. If you're UK based, you might have to do a couple of tweaks. So for example, you go to passive income. What you want to do is, imagine you want to add basically you bought a new 5 shares of Qualcomm. You just put 5 in there, you put the price, it tells you everything else basically takes care of. The only other thing you need to pay attention to is this column here if you're in the UK, right? So this is the dividends that this is automatically, there's a formula there, so it does it automatically for you, and this one you kind of have to change it yourself if you like. Okay, so as you can see, some of these data is not correct. So for example, Microsoft has increased their dividends recently, so all you need to do, okay, instead of $2.24 you change it to $2.48 because that's the automatic. So if you change that bit there just to 48, that's it, and it automatically calculates for you. So that's the only thing you need to do. So you put your thing in there, price, the stock that you bought, how much you paid for. If you're in the UK or the US, you can easily change that, it doesn't matter. The dashboard will give you the overview, then you've got growth portfolio in there, the dividend income. Okay, you can just put it in there and it automatically does everything for you. So I've shared this with you guys before. You don't need to redo the whole thing. Okay, just use that, inshallah. And if you find in any of these videos of value, or you find it, maybe you like this idea, whatever it is you like about these videos, just please like them and subscribe and let me know if you have any questions. Right, let's get started on the video. I've now put together, okay, 6 stocks, defensive stocks, 6 fast growers and 6 cyclicals. Now, defensive stocks are stocks that if the stock market goes down tonight, okay, they are the ones that because they have a solid business model, they don't actually fluctuate a lot. They have a lower beta, and when there's a recession and things like that, they still do well. The reason for that is because it's a household stuff, the stuff that we really need. Okay, so from Procter & Gamble to Unilever, Johnson & Johnson, Coca-Cola, Clorox, and Mondelez is probably the only one that we haven't spoken about in this channel, but this is the company that sells the Oreo cookies and so on. They do a lot of snacks. Okay, so these companies tend to do well in terms of in a recession time. They grow up their business about 2 to 10%. Now, before we get to the explaining the whole situation, I've got a couple of ETFs as well. The criteria, that the reason why I selected these businesses is this. Okay, so we want the 5 attributes that we're looking for is revenue growth, net income. So your revenue growth, you maybe want to see 5-year revenue growth. And you can easily do this research yourself. So I researched now APD or Air Products and Chemicals. I've gone to financials. You can see last 4 years or 5 years depending. You can see their income statement. So if you go to the income statement, you can see 5 years. So from 8.9 to 10 billion. So that it's growing in the right direction. So this means the business is actually generating more profit, probably reinvesting that money to grow their top line. So this is what's called the top line. Okay, you also want the company to grow their bottom line here, the net income. So after they paid all that taxes, whatever, they made this much, they paid some taxes, they paid everyone their salaries and all that stuff. The net income, they netted about this $2 billion. Okay, they also have a free cash flow and things like that. So that's how to look at these things. Okay, right. So if we close this, go back here. So revenue growth, you're looking about last 5 years, it's heading in the right direction. Net income growth is also heading in the right direction. Then you also need to look at strong free cash flow. So in the last 5 years, so for example, right? So if you go to cash flow here, is this business actually growing their free cash flow? Some businesses might be growing this for 2-3 years and then there is a stop. Because what might happen is they might acquire a new business or they might pay off some debt that they had. So there's sometimes a reason why this is not growing. But if it's consistently heading the right direction and maybe there's 1 year where it's not that great, that's absolutely fine. Okay, but 5 years, if you can get 4 years, even 3 years, I would still be okay with it. Okay, if the top line's still growing, the bottom line's growing, free cash flow is not that as great, but can the free cash flow actually help the business to keep increasing their dividend? And if the answer is yes, then you'll be fine. Then we're looking at profit margins of more than 15%. Okay, so after the company has paid all the expenses, this is the money that's been left. And if that's 15% of the top line has been actually as a realized profit, then that's perfect. Okay, 15% is basically what the industry, they say 10%, but 15% to be on the safe side. And return on equity is the money, so basically is indicates how well a company's management deploy shareholders' capital. So you invest in money into this business, okay? How much of that, basically, what are they doing with that money? That's basically it. If the company is reinvesting that money, if they're buying a new company, if they increasing their revenue somehow by taking that money and doing something useful with it, buying a new company, pay some dividend, whatever it is, right? Then that's perfect. And we're looking for return on equity of more than 15%. Then the bonus attributes that I like to look at, okay, are dividends. Is the company paying a dividend? If it's yes, it's perfect. In fact, this should be there, okay? And we're looking for dividend yield that is less than 5%. Anything above 5 or more, that is just not sustainable, okay? The big companies do not pay that much. It's just small companies that do not have that much of a growth in them. They're very dangerous. They can cut their dividends straight away. But if you want a solid dividend that you can rely on, you're looking for from 1% to 3%. 4% is even the higher end, okay? Then you're looking for dividend growth. So you're looking for dividend growth of at least 5% or more every single year. And if you can get that, that's perfect. Okay, so that means this, if you started with 1%, in the next 5 years, the company will grow that dividend to 2%, 3% and more, basically. That's what it means, okay? And the payout ratio is out of the net income. So the net income they've actually taken, how much of that money are they spending on basically paying these dividends? If it's more than 75% or 80%, then that's dangerous because they can cut it any time. But if less than 60%, that's perfect. This is basically what the industry says, okay? Less than 60%, then that should be okay. So this is the criteria I look for when I'm looking for a new business, so and so, okay? And if you're starting, this is a good idea to look at their top line revenue. Is the company actually making money and is it growing every single year? Is the net income growing as well? Do they have a free cash flow that they can, if something happens, they can reinvest in the business, they can buy back shares, they can reinvest whatever it is or pay you dividends and so on? Is the profit margins growing? Okay, are they keeping some of the top line revenues to themselves? And are they doing something useful with your money? If it's all of these things are ticked, okay, then you look at if they have a dividend and you look at this. Right, so let's go back to the top. So these companies here, the defensive, like we said, they grow about 2 to 10% every single year. They're solid business. They've been around for a long time. They do pay some dividends, okay? They are happy to pay that dividend because they make so much money, especially Procter & Gamble. It's like a money-making machine. Right now, it's really overvalued, okay? And I'll talk about that in a second. But they do generate a lot of cash. That cash is then paid back to the investors as a dividend, or sometimes they buy back their shares, or sometimes they acquire new business. Some of them, they grow their business by just buying other businesses. So they find the newest Head and Shoulders business, whatever, because remember, Procter & Gamble owns Head and Shoulders. So if a new business comes up with a better product, they most likely they will buy that business straight away and add to their portfolio. Okay. Now, in terms of the valuation here, I've used the Morningstar. And the reason I use the Morningstar is not like I just like their model. What I like about their website, what I like about them is they use what's called the discounted cash flow. This is a metric to use, or this is a method to find out, okay, how much basically cash this business is going to create in the next few years based on the estimates. It's quite difficult to estimate, and that for that reason, I don't actually like to talk about discounted cash flow myself. I don't like doing it myself. It's a headache sometimes because you're predicting what the business might generate in about 5 years, 10 years, whatever. And for that reason, I just use Morningstar. And Morningstar is one of those great websites where it tells you straight away 4 stars means it's cheap, okay? And it will tell you, for example, Salesforce is now a discount, 21% discount, means basically it's cheap. It should be $320 per share, but currently $254. They use that, and their model is actually better than the ones that I've seen out there. There's some companies that use some similar sort of a model, but they are slightly linear. They give you, basically, they're not as strict as Morningstar. So I do like Morningstar and I use them, but sometimes I deviate a little bit away from them, and that's absolutely up to me, obviously. So as you can see, some of the business that we're looking at today are overvalued, some are fairly valued, and some are obviously undervalued. So the ones that are undervalued are green, the fairly valued are this, and then you got premium ones. So Procter & Gamble right now is very expensive, Clorox is very expensive. The other three here, you can see, are fairly valued. So if you bought them now, you'll be fine. I'm not giving you financial advice, but I'm saying generally. Like if you bought them now, it's basically they are trading around where Morningstar expects them to be right now. Okay, and Unilever is the only one that's discounted, 9% discounted. Then you've got fast growers. These are companies that grow 15 to 25%. Some of them do pay dividends, some of them don't. So you've got Microsoft, which is fairly valued at the moment. You've got Nvidia, really overvalued at the moment. Qualcomm, fairly valued. CRM, Salesforce, they don't pay any dividends, but they are discounted at the moment. Tesla, against 60% premium. And then Adobe, 10% discount. So some of these businesses here are, I believe, will be around for hundreds of years. Microsoft is not going anywhere. Nvidia is by far one of the best businesses out there right now. Okay, Qualcomm, great business. They were relying on a lot on Apple, but now they're diversifying their business to the point where they might not even need Apple anytime soon. So 20% of their revenue used to come from Apple, but they've diversified so much that's reducing, and they are making a lot more investments in other places. CRM is basically great business, is growing. They don't pay any dividends, but it's perfect business for me anyway. I own shares in this business as well. Tesla, by far one of the best performing stocks out there. Really overvalued at the moment. If this stock goes down to the valuations that I want it to be, I will be buying hundreds of shares, no doubt. If I have the money, that is, by the way. And then Adobe, great business. I like their business. I used it a lot. Okay, and then right now they are discounted. So right now I think Adobe is, in fact, if I quickly check, I think it's 4 stars according to Morningstar. So let me just quickly double check that before we move on, and then we'll finish the video off. Okay, yeah, 4 stars. 4 stars means basically probably one of the cheapest out there right now. Okay, then we've got cyclicals, companies that are basically grow their business about 8 to 15%. These are business that we don't really need, if you like. Okay, so they, depending on how well the economy is doing, this business will grow. If the business is if the economy is doing really well, this business will be booming. People will be sending things to each other. Railroads will be delivering stuff. Okay, people will be eating and drinking so much, they will create so much waste, and then the waste management will take care of it, and so on. Okay, so that is the kind of businesses they are. So it's not essential businesses, but these businesses that we might use. Right, so UPS, I'm sure you know, Union Pacific, I've talked about before. There's a video there on my channel, you can check that out. Railroad company, waste management, garbage company, they collect garbage, they recycle it, they do all of that stuff. Amazing business model, very small dividend, but that's great. Air Products and Chemicals, we've talked about them before in the channel, just last video, so if you want to check that out, do that. Activision Blizzard, they're the company that creates all the games out there. Okay, so Call of Duties and all that stuff, really undervalued at the moment. And then Lenore is basically corporation, is in the home building in America. So they do build the homes and resell it to the consumers and so on. So some of the businesses you can see here are also undervalued. Some are fairly valued. Some are basically all way overvalued. Now, if you are just happy to pick stocks, I think this is what I would have done, something along these lines. If you feel like you need a bit more hands-off kind of thing, then maybe look at these ETFs. I've got a video coming up this week about these two businesses, so Halal and SPUS. I will be doing a video on this first, and then we'll talk about the iShares ones after that as well. So I've got two videos coming up on about these two set of ETFs. So if you want to wait and watch that, that will be absolutely fine. But yeah, so if you want more hands off, probably just get into these ETFs, do your research, make sure you know how they're Sharia compliant and all that stuff. And I'm going to try to do the best that I can to basically literally look at the whole business and everything they're doing, whatever, and how they're Sharia compliant and all that stuff. So inshallah, the next couple of days I should be doing a video on this, and then the couple of days later I will be doing another one for this. So inshallah, just keep an eye on the channel. Inshallah, something good will come out of that as well. So yeah, that's it. So if you're interested and you're basically starting and this is your first time in investing, whatever, then maybe look at businesses that have been around for a long time. They have a great business model, they have a moat, which basically means they have a competitive advantage over other businesses that are in the same industry and so on. Okay, some do pay some dividends, some don't pay any dividends. There's a bit of growth in them. So if you can grow your money 2 to 10%, is better than sitting in the in savings account where inflation is eating your money every single year. That's better. If you can then maybe get fast growers and start making about 10 to 15% every single year, so that you can do that. Look at my portfolio. I started this portfolio about 2 years ago, okay, and right now, as you can see, is up about 17%. So unrealized gains of £6,300. If I was to sell right now everything, I'll make 17% of my money. Okay, I already have taken about £3,000, okay, of realized gains. I've already sold 3,000, made a 3,000 profit, basically over £3,000, and I reinvested it straight. I've never taken a penny out of this portfolio. I always reinvest everything. So yeah, so if you're starting, okay, maybe look at my links here, okay, sign up, maybe trading with 212. Sign up with Freetrade. Freetrade, the only issue is you have to pay for ISA account, you have to pay £3. If you're in the US, that's completely different. I'm sure there's so many brokers out there that you can actually use and so on. I hope you enjoyed the video. If you lasted this long, just give me a thumbs up. I really appreciate that. Thank you very much. Take care. Have a great day.